To give you an example of what area patterns would look like, we showed to you what an ascending triangle looked like a while ago. So let's just quickly go through them. You can study many of these on your own. Many of you, if you have time, please go to a website called stockcharts.com and click on the link called Chart School and look for the area pattern category there. It'll give you good review materials on how to be able to study each of the every one patterns that you have here. I can only cover so much today. In general, what we're going to do is we're going to be looking for consolidation or sidewinding movements in price. We will draw our two lines on them, and then we will describe to you what those lines are depending on what the positioning of these two lines look like. Also, it can help you make an assessment whether does this have greater chances of going up or down. And going through this, let's review on what the potential for each one of this is. So beginning with the ascending triangle. So the ascending triangle has a flat top and has a rising base. And so you can see eventually over in time, if this were to just continue, these two lines will eventually meet each other. And since, like I told you earlier, this describes a seller who is neutral and describes a buyer who is intent to buy, an aggressive buyer. And so an aggressive buyer facing a neutral seller will show you greater chances of this going up. If this were to break out of that pattern, that means it were to break resistance, it will go up by a minimum distance of this vertical size that you see here. And so the measuring formula would be to go all the way back up here as a target. All right, and your entry point should be as soon as prices attempt to break out. Let's look at the next pattern. This is a descending triangle. This is opposite to an ascending one. In a descending triangle, you will notice that the demand line or your support line is flat. That means your buyer is neutral. Your seller is now aggressive. He is the one willing to sell prices down lower and lower. And that means he's in a hurry to sell this stock. And so if you have an aggressive seller versus a neutral buyer, the greater chances are this would eventually break down, and a crack of support should be your exit strategy here. And the downside capacity would be the vertical distance that you see on your descending triangle. So extend that downwards and you have your target. The third type of triangle is what we call a symmetrical triangle. Symmetry meaning identical or happening in the same order fashion. In a symmetrical triangle, you will notice now that your demand line is actually going up and your supply line is actually going down. So resistance is going down and your support line is going up. And so again, eventually these two lines will meet, but you can see what's happening here. It contained the price and eventually it started to flail towards the lower end and eventually broke down. Now in a symmetrical triangle, just like a rectangle, this is normally very neutral, hard to say whether it's going to go up or down. But again, you will see what was the prior trend before this pattern began. And since that pattern was a decline, then I would assume that there's greater chances for this to continue with its decline. So 60% of patterns like this, if it comes from a decline, will continue to decline. And maybe a 40% chance it'll actually break up on top and turn itself around. The exit strategy, as soon as it breaks support, you sell and you wait. Your targets would be that the price would fall back down a distance equivalent to the height or the vertical distance you see here of the pattern. So we just keep doing the same thing over and over again. And whatever pattern we discuss, we just contain them in two lines. If it breaks over resistance, it's a buy. If it breaks below support, it's a sell. Another type of continuation pattern is what we call a rectangle. We covered this earlier. Here you have a flat support line, and here you have a flat resistance line. A breakout above tells you it's time to enter, and your upside target will be the vertical distance of this. Now, although these are usually continuation patterns because they continue the prior trend, it's quite possible to find this sometimes at tops. And so if this were to break below, then you would sell if this support line will break. Next pattern is called a bullish flag or a bullish pennant. Now, there is a bearish version of that, but let's start with the first. So a flag or a pennant is actually a temporary or short pause in price. These patterns only take maybe a few days to happen. They normally start with a strong trend move. They park maybe within a week or two, and then they explode into a really strong upward movement. Now, the measuring formula that we'll use when we gauge flags and pennants is a bit different than what we have here. because instead of measuring the size from top to bottom of this body of this pattern, we will measure what is known as the pole of this particular pattern. Pole as in a flag pole. So if this were to be a flag, this is the pole of that flag, and the measuring form will be the high side of this pole to the lowest side of the pole, and that's what we're going to use to extend upwards here. So after that, you can see here it rockets up like with fury. Although the target was over here, it way past that particular target. And next, it stopped and it generated what is known as a pennant. So a flag is more likely like a small rectangular thing, whereas a pennant looks more like a triangle, but it only happens within maybe from days to maybe a maximum of 1.5 to 2 weeks in total. So in this case, you have another small triangular formation. Prices broke out of that, and you will see prices leap up from that area. Just as we did before, your buy should be as soon as prices break over the range, and the measuring formula should be the height of the pole. In this case, the pole started from here all the way up here. So you can just imagine why this is going up quite quickly, because a lot of technicians who know how to trade this are jumping after the potential upside magnitude of this. Next, let's look at the opposite of this. This is what is known as a bearish flag or bearish pennant. The first one is a flag. This is also a flag, and this could be a potential pennant. So remember, if it looks more rectangular, it is a flag. If it is more triangular, it is a pennant. Okay? And again, it only lasts for maybe a couple of 1 or 2 weeks. After that, it breaches it, and from there you get a support crack, you sell, and you get an immediate decline. It builds a new consolidation pattern, a small rectangular movement, crack support again, and it heads off into a decline. The measuring formulas are, again, the pole of the flags or the pole of the pennants are what you use, and extend that from the breakout point to the next downside target. And please, of course, within reason. Because, for example, if you have an area pattern trading at 1 peso and it came from 2, and you have a 1 peso range, and it breaks down below a 1 peso support, that stock cannot go to 0. So it might go close to it, but it will not go to 0. So there has to be some degree of reason when you try to evade uses, especially into a downside. Now let's look at the second type of area pattern. Those patterns we looked at earlier are what we call continuation patterns because they continue the prior trend. These are called reversals because they reverse a trend. Let's start with the first, and this is one of the more popular ones, a double top formation. Now a double top would look like this. An uptrend going to a very nice strong move, first correction, rebounds, hits the previous high, maybe could pass it slightly or maybe just under it a little bit, and then falls back down more rapidly. And then you see it break the prior level of support. This confirms that you've seen a double top. Now, in a double top condition, you will only see this in tops, as the name suggests. But you will see the opposite of this at the bottom of a chart called a double bottom. Now, let me try to explain to you the need for this. Remember, I told you in the prior seminar we did was that trends change course gradually. And from an uptrend, they will go sideways first before going down. And this is the reason that an upward move after its first correction will try to come closer to the previous high to test that area of resistance and see if it's really still there. And if it is, and then it backs off more substantially because now the whole market knows there is a big seller there and they're withdrawing from that market much more forcefully. And that's what can generate an opposite force that changes the trend condition from sideways to down. So the selling condition here can happen in 2 ways. If you can see that the first top fails to secure into a new high, you can use that as a temporary profit-taking area. That means when I say profit-taking, you don't have to sell everything. That means you can sell a portion of your position. But if support is broken, you must unload all because now your downside has just been magnified. And because of that increased risk, you want to be able to make sure that you contain that risk from you getting hit. Another type of reversal pattern is known as a rounding top. Rounding top because you will see it's a really gradual sway from an upward true to a sideways one. Eventually it curves downward and eventually accelerates into a decline. You don't see this all the time, but it happens. And normally when it happens, the effect of this is very, very clear, and it's probably right 90% of the time. And so these rounding tops or rounding bottoms, the opposite of this, may be good clues to us because it gradually gives you that information. It gives you time to prepare for it. And so it's very hard. The lower end of that could also be support levels like this. If cracked, then you exit from that particular point. And finally, there is another type of reversal pattern that's been very popular to technicians, although I'm sorry, it doesn't happen too often nowadays. But a lot of technicians love to be able to identify one, and many identify them wrongly. And let's talk about what it looks like. So a head and shoulders pattern looks something like this. So if you were to look at me, you can see my shoulders are lower than my head. So what will happen is that your first high will be here, followed by a higher high, and then followed by a lower high again. And so if you look at this situation here, here's the first shoulder, followed by a higher high, the head, and then it falls back down to a support line, rebounds again, and makes again another lower shoulder on this. After the right shoulder is demonstrated, you will likely see it already for yourself that a high comes into a lower high, and you and I know that that is the definition or the beginning definition of a downtrend. And so this is also similar to this, a gradual turnaround from trend, and the measuring formula of this would be the height from what is called the neckline, the support line you see down here, neckline, all the way up to the head area, the top of the head area. So we will now measure the top to this neckline point, and this we will extend from the breakdown zone to command a potential downside target in price. So when you see a head and shoulder, it can really take a wallop in price, especially if you see them on top. If you see them on the bottom, it might be a good situation that upon the right shoulder of a head and shoulders reversal, which you find in bottoms, to be able to buy into the right shoulder because a potentially big reversal pattern is getting in, and that could be a big money-making opportunity for you. And the last patterns I'd like to discuss, these could fall either way. They could sometimes be continuation patterns, which continue a trend. They could be reversals. So we will just look at them because it can happen on two sides. The first is what we call a wedge. We have what's known as a rising wedge and a falling wedge. Now, normally a wedge is a continuation pattern. But in modern day trading, we've noticed that certain wedges, such as this one, happen after a decline. So you can see it falls down first, makes the wedge. The wedge looks like a triangle. The only difference between a wedge and a triangle is that in a wedge, you will notice that the two lines, your demand and supply lines, are pointed in the same direction. Whereas in a triangle, one of those lines are not the same. One is flat or one is up, the other is down. Never will a triangle show you two lines pointing in the same direction. If you see a situation like that, it's more likely a wedge that's being developed. And normally, as a general sense, whichever way the wedge points at, it intends to go the opposite way. So for example, if you see this, what is known as a rising wedge, line pointing up, line pointing up. So if that wedge is pointing up, that tells you the potential trend is to go down. And you can see what happens here afterwards. This is a particular worry for us because our market today, in a rebound that we've been seeing, it seems to be making something like a rising wedge. So we have to be a little careful that a potential pullback in the market can happen. So you can see I'm using a pattern that I've seen before, and I'm using that to describe what we're looking at into our market to help make a judgment call. And now I'm a bit more ready to be able to face that in case that situation happens. So in a falling wedge, the two lines are pointing downwards, and that's telling me eventually this is going to go up. And so a breakout is what I'm waiting for to be able to make an entry, and it did so. And the measuring formula, just like a triangle, would be the top end to the lower end of the range. In this case, it's the top end to the lower end of the range. Project it upwards in a falling wedge, project it downwards in a rising wedge. The other type of pattern that's also quite interesting, and relatively modern day patterns also appearing to this, is what we know as a cup and handle. Long time ago, I would only find this on the bottom of charts, but nowadays I would find them as a continuation in the middle of the chart, sometimes right coming off a major bottom, because it generally makes a combination of like a rounding bottom, and then it fishes out a pattern here, and then breaks free, and then makes a fantastic upward move in price. The nice thing about it takes time to build, so it cannot surprise you. So it's very clear when these patterns take place. First, it looks like a rounding bottom or a saucer, and then you will see like a handle come out of it. That's why this is the cup, and this is the handle of your cup. And in that handle, you have to get prepared to be able to buy this, because this can make a very, very strong move. The upside configuration would be the low end of the cup to the upper end of that cup, and you just project it upwards inside. Again, any breakout is a buy, so you buy it here and you wait for your projected target. Finally, we have what is known as a reactive channel. I think I pointed this out to you last time in our last seminar, but since it's also technically a ranged pattern, we'll also talk about how to use it. So remember, in a reactive channel, ideally you should be looking to sell or buy this on the low, buy on the low side, sell on the upside. But if the trend is downtrending, you should really just be using this rally as an opportunity to sell and to stay out of the market until this trend changes its course. If this is an uptrending channel, then you should just be concentrating on buying every support bounce you can and taking a little bit of profit when you see the high boundary or when it hits that price channel high, and then buy it back whenever the stock price rebounds off the support low. So again, different patterns, you can have a little different technique, but remember, even in a downward channel like this, if you get a break above resistance or a break above this area here, it is also a potential buy, but please make sure that your support levels are near to your resistance rather than too far away, because it might make your risk condition too far. So the way I would rather do this is, if this is a potential breakout condition in a reactive channel, what I would want it to do is either move up towards resistance, wind up here first before breaking out, and that might spell a good setup entry for you, rather than rallying from the ultimate base, breaking out, and then having to stomach a temporary correction because it's too overbought and waiting for your entry there. So just be careful about that. Do not chase prices, okay? Even in a breakout situation. All right, let's have a demo of how to be able to spot this and what do I do in a pattern in terms of looking at them in our charts. So let's run through this demo. So I have here a chart of AGI. Now, I chose this because it went through 3 trends, up, sideways, down. And now let's try to figure out where these patterns will be. So just offhand, look at where these little patterns be. You'll see up and down movements, draw 2 lines, and after you draw the 2 lines, and then you call it out. So you have a rectangle. Then it breaks out from that, goes up, and then eventually makes a correction. And then you can see up here, it creates a new consolidation. Let's just draw that out. Again, flat top, flat bottom, another rectangular range. This one broke down, rather broke out topside. Then it started falling back down again. And then after falling down tremendously, it became oversold and it built a new pattern. So let's draw our 2 lines. So if you notice here, the flat line is your demand line and the selling line is going down. So that's a descending triangle. And eventually it broke down. So these breakdown conditions that you see from these 3 areas here are really what we want to look at in a stock price. It offers quite a degree of help because it gives us preparatory conditions. I know what's about to happen. It could either break down or break out. If I can see that it's challenging resistance, then my situation as a trader is to get ready to be able to buy this. If it looks like it's getting ready to break down, I should start becoming more defensive. And the minute that support breaks, I'm out of there because it could change the trend and cast off a very, very big decline. So if you notice what happened in this end, it was quite a nasty decline. And you might say enough is enough, and that's probably why it parked here for a while and created a new pattern. But the descending triangle here is telling me that the seller is still very strong and the buyer is just very neutral, and that this could still go down. And sure enough, that's exactly what happened. So use area patterns as a ability for you to get a good sense of range. If it's big enough for you to trade, then you can buy and sell within the range. But the minute you see a new trend or a trend erupt from it, then follow it through a breakout condition or a breakdown condition.